Hey there, and welcome to This Explainer. I'm honestly so thrilled you're tuning in today, because what we're going over, it's going to completely shift how you view your future. Think of me as your mentor for the next few minutes. If you're a student, a recent grad, or really just someone looking to finally take control of your financial destiny, you are exactly in the right place. Today, we're laying out a concrete blueprint for building your very first investment portfolio. We're moving away from that daily grind and looking at how you can actually take ownership of your financial life.
Okay, let's dive into this. And we're going to start with a pretty tough question. What if the very thing you rely on to live is actually the thing holding you back, right? I mean, from a young age, most of us are taught this very specific, unquestioned formula. You go to school, get a good job, work incredibly hard, and then eventually you retire. And look, there is absolutely nothing wrong with working for a paycheck. But the trap snaps shut when a paycheck becomes your only source of income. Because when you do that, you're just trading your time for money. And last time I checked, you only have 24 hours in a day. No matter how talented or dedicated you are, your earning potential has a hard ceiling because your time is literally limited. If you stop working, well, the money immediately stops too. That's the cycle that keeps millions of people struggling financially decade after decade.
So how do we break out of that cycle? Well, here is your wealth building blueprint. We'll be going through Section 1, the wealth mindset shift. Then Section 2, buying true assets. Section 3 covers avoiding lifestyle inflation. Section 4 is all about the magic of compounding. Section 5 tackles smart risk and diversification. And finally, Section 6, your simple investment plan.
All right, let's jump right into Section 1, the wealth mindset shift.
You know, building wealth really isn't about incredible luck or even having a massive salary. It's actually about a fundamental shift in how you think. Let's look at the mindset of the average earner. Their primary question is almost always, how can I earn more money? Which naturally means trying to get more hours, asking for a raise, or maybe picking up a second job. But again, they're completely bound by those 24 hours in a day. The wealthy individual, though, they ask an entirely different question. How can I own things that earn money for me? This shift is literally everything. It's the transition from just being an employee of your own time to becoming a true owner of systems that work independently of you.
Moving right along to Section 2, buying true assets.
Now, what's really interesting about this is that to build wealth, you've got to know what you're actually buying. And for a total beginner, here is the only definition of an asset you need right now. An asset is something that puts money into your pocket and generates income even when you aren't working. That's it. Simple, right? But it's absolutely crucial to contrast this with liabilities. See, most people spend their hard-earned paychecks on liabilities, things that take money out of their pockets over time, like, expensive cars or the latest high-end electronics. The wealthy, however, use their money to buy assets. This seemingly tiny difference in spending habits is exactly what creates a massive wealth gap over the decades.
So what can you actually buy to build your modest first portfolio? Well, here are some really common examples of true assets. You've got stocks, which give you partial ownership in a publicly traded company. Businesses, which can generate profit without your constant everyday labor. Rental properties, providing you with monthly housing income. Royalties, which pay you for the ongoing use of something you created. And dividend-paying investments, which literally hand you a portion of a company's profits just for holding their stock. These are the specific tools that are going to do the heavy lifting for your financial future.
Next up is Section 3, avoiding lifestyle inflation.
Okay, so knowing what to buy is only half the battle. The second major mistake happens when you land that first big job or get a major promotion. Imagine you finally get that raise. What most people fall into is what we call the raise trap. They immediately celebrate by upgrading their lifestyle. They rent a bigger apartment, finance a newer car, or go on luxury vacations. And hey, at first, it feels incredibly rewarding. But then, as their income rises, their expenses rise right alongside it. This is exactly why a high-income earner can still feel totally broke. Every single extra dollar is spent instead of invested. The wealthy do the exact opposite. They increase their investments before increasing their lifestyle. They let their assets grow way faster than their expenses. So my advice to you? Invest first and spend what's left.
Which brings us to Section 4, the magic of compounding.
And this brilliantly illustrates the real secret engine of wealth building. Why is investing early so powerful? Because of compound growth. Compound growth happens when your money earns money, and then that new money earns even more money. Think of it like planting a single tiny apple seed. You water it, and eventually it grows into a tree. That tree produces apples, which drop to the ground and plant dozens of new seeds. Those grow into more trees, producing hundreds of more apples. Suddenly, you don't just have a tree anymore, you've got an entire orchard. That is exactly how compound growth works. It's an invisible acceleration happening right beneath the surface.
Notice how this exponential growth accelerates over time. Over 10, 20, and 30 years, the growth doesn't just go up in a slow, straight line. It curves upward dramatically. Now, in the early years, the growth seems painfully slow. And frankly, this is exactly where most people quit, because they don't see immediate, life-changing results. But the wealthy, they stay patient long enough for the compounding magic to truly accelerate, knowing that true wealth often looks invisible for years before it suddenly appears in a big way.
Let's make this real with a hypothetical scenario of two recent graduates over a 10-year period. Graduate A is the spender. They save nothing, buy a brand new car, and purchase luxury clothes. The result? Sky-high expenses and zero wealth. Then we have Graduate B, the investor. They make consistent, small monthly contributions into an index fund. They aren't putting away millions, just a steady, modest amount. Their 10-year result is accelerating compound wealth. It's honestly incredible how drastically different habits shape your long-term outcomes over a single decade.
All right, Section 5, Smart Risk and Diversification.
As a beginner, putting your hard-earned money into the market can feel pretty intimidating, but we really need to reframe that fear. So the crucial point is comparing the perceived risk of investing, which is just short-term volatility because yes, the market goes up and down, with the silent, guaranteed reality of inflation. Inflation slowly eats away at the purchasing power of your cash. If you just leave your money sitting under a mattress or in a basic checking account, it is absolutely guaranteed to lose value over time. Successful investors know that avoiding all risk is, ironically, the biggest risk of all.
The way you manage that short-term risk is through diversification. You just don't put all your eggs in one basket. Instead, you might buy a slice of U.S. stocks, a slice of international stocks, and maybe some bonds for stability. By spreading your money around like this, you protect yourself if one specific area of the economy has a rough year, while still perfectly setting yourself up for long-term growth.
Finally, let's head into Section 6, your simple investment plan.
Living without a financial strategy is kind of like taking a road trip without a destination. Let's move to the next step and see how this builds your very first portfolio plan. Step 1. Set a clear, long-term financial goal. You need to know why you're building wealth. Step 2. Focus on learning to understand risks before you leap. Step 3. Make small, consistent investments. Remember, consistency beats the excitement of get-rich-quick schemes every single time. And Step 4. Stay patient and let compounding work its magic. Real millionaires are built through decades of discipline, not overnight speculation.
I want to leave you with this core thesis straight from our source material today. Most people work for money their entire lives. The wealthy make money work for them. This single sentence perfectly summarizes the fundamental shift we've talked about today. It's the leap from being a mere employee of the clock to an owner of your own time and future. And the sooner you embrace this, the sooner you start truly building wealth.
Thank you so much for learning with me on this explainer today. I really hope this blueprint gives you the clarity and the confidence you need to start building your own portfolio. But hey, learning is just the first part. Action is what actually matters. So I want you to really think about this. What is one step you are taking today to build your freedom? Start small, stay consistent, and I will see you next time.